If you want a stress-free investing strategy, stick around because I'm going to show you how to use just 5 Vanguard index funds for your entire investing strategy. I'll reveal the dangers in index funds and how to get that return to beat your goals. We're talking index fund investing today on Let's Talk Money. Beat debt, make money, make your money work for you. Creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So this is going to be a wildly requested video, and I know there are a lot of index fund investors out there. The idea of index fund investing is really intuitive. You buy just a couple of funds that hold hundreds of stocks in each. You don't have to worry about picking stocks or the stress of trying to beat the market. So I'm going to show you how to use just 5 Vanguard index funds to create your entire portfolio. We're not talking just about stocks here. I'll reveal the 5 index funds you can use to get exposure to bonds, real estate, international companies, as well as US stocks. This is going to be a complete portfolio you can use to beat your investing goals and never have to worry about stock picking again. After we look at those 5 Vanguard index funds, I'll also show you a strategy to have the best of both worlds. How to get that stress-free index fund investing, but still get the opportunity for higher returns in a handful of stocks. So stick around for that strategy. First, I do want to point out one disadvantage of index funds that most investors don't know about. Now, a lot of investors ask me why I don't just invest in a broad market index fund like the S&P 500, why I invest in individual sector funds instead of just one fund for the whole market. Now, the answer is in what you get in that broad market index fund. If you're buying the entire S&P 500 in one fund, you're getting more than a quarter of that in technology stocks. In fact, you'd have more than 2/3 of your money in just 4 of the largest sectors, including IT, healthcare, financials, and consumer discretionary. Now, 3 of those 4 sectors are highly cyclical, falling fast in a recession, so you're pretty much at the mercy of the market when it comes to a stock market crash. Even worse is that the size of the sectors in the market fund have changed over the years. That makes it even harder to manage your investment risk. Here we see that the size of those largest sectors have increased, while some of the safety sectors like consumer staples have become a smaller part of the market. Shares of utility companies, some great dividend-paying names, are less than 3% of the market fund. So there is a risk to index fund investing. In that 5-fund portfolio I'm going to share, some of that risk is reduced because we'll have different assets. I'll also show you how to limit the risk even more in that special strategy after I reveal those 5 funds. I'm going to be using the Vanguard index funds here because the company offers some of the lowest cost funds available. The funds we'll be using charge an expense ratio of between 0.07% to 0.12%. That means you'll pay less than $10 a year on a portfolio of 10,000 or more, and you get that exposure to thousands of stocks, bonds, and real estate companies. Now, I've got no affiliation with Vanguard and I get no commissions for recommending them. I've invested in the funds myself and recommend them to private wealth clients throughout my career. The first Vanguard index fund in our portfolio is the Dividend Appreciation ETF, or ticker VIG. Now, this fund holds 182 companies across sectors, some of the largest companies in the market like Microsoft, Walmart, and McDonald's. The fund pays a 2% dividend yield, which is only a little above the market, but is balanced by solid price growth. Over the last decade, the fund has produced an 11.2% annual return, which is one of the highest among the Vanguard funds. The fund also gives you better exposure to some of those safety sectors like consumer goods and services, so it's not nearly as overweight in tech or of the other sectors that you'll usually find in a growth fund. Our next fund is going to complement that dividend fund so we get a little bit more growth. Here we have the Vanguard Mega Cap Growth ETF, or ticker MGK. This fund holds shares of 120 companies and has produced a 13.7% annual return over the last decade. The dividend yield here is only 1.4% because the focus is really on stocks that grow faster rather than returning that cash to shareholders. The sectors here are weighted to growth, so you've got more of that technology and financials and healthcare compared to the dividend fund. Now, I really like the combination here from the 2 Vanguard funds because you get solid dividends and price growth. Investing in the 2 funds gives you a more balanced investment across sectors versus just investing in that broader market index fund. Now, a lot of investors avoid international stocks and think they get all the exposure they need from those large US companies. They're missing out on a huge opportunity for higher dividends and less risk though. Investing directly in international companies takes a lot of the risk from that US dollar and other economic problems. Any company based in the US is going to be exposed to these, even if it has a lot of foreign cash flow. So you really do need to have at least one international stock fund in your portfolio. For that, I'm going to suggest the Vanguard International High Dividend Yield ETF, or ticker VYMI. The fund holds shares in over 900 international companies and pays a healthy 4% dividend yield. What I like about the fund, besides that solid dividend and average 9.7% annual return since inception, is that ability to get exposure to fast-growing emerging markets as well as developed markets around the world. The fund has half of its exposure to relatively safe companies in Europe, but also 20% in EM stocks and Asian growth. Just those 3 Vanguard funds are going to give you all the stock exposure you need. Now, how much you have in these is going to depend on things like your age and your investing goals. Most people are going to want between half to 65% of their portfolio in stocks, but don't neglect the bonds and the real estate funds we'll get to next. These 2 funds for bonds and real estate are going to smooth out your risk in stocks, provide some great cash flow, and even give you the opportunity to take advantage of lower prices when that stock market crash does hit. For the bond part of your portfolio, we have the Vanguard Long-Term Bond ETF, or ticker BLV. Now, bonds have gotten absolutely smashed this year on the increase in interest rates, but that means it could be one of the best times to be adding this to your portfolio. Even that 6% loss the fund has taken over the last year is nothing compared to the 10% plunge stocks made in the month of October alone, or that potential for a 50% drop in stock prices during the next crash. After dividends, this fund protected your money completely over the year to March 2009 and would have been a great opportunity to get stocks at bargain prices. The fund pays a 4% dividend and has 42% of more than 2,000 bonds held in U.S. government debt. All the bonds are investment grade, so extremely safe credit ratings. Now, our real estate fund here is my favorite, the Vanguard Real Estate ETF, or ticker VNQ. Real estate is another sector that's been hit on those rising rates this year, but the fund has held up and pays a 4.4% dividend yield. Listen, there's no better asset than real estate for creating that long-term wealth. We've got another video on the channel covering the 7 real estate strategies I used after getting out of the Marine Corps to get started with no money down, and I'll link to that in the video description below. The problem is that even without having to come up with tens of thousands of dollars for a down payment, property investing can still be a lot of time and a lot of work. REITs are a great opportunity to get that growth and that cash flow without all the work. Now, the Vanguard Real Estate Fund has produced an 8.4% annual return since its inception in 2004, and it holds shares of 184 real estate companies. This is a must-own fund for its diversification in every property type and in every region. You can create a complete investment portfolio with just these 5 Vanguard Index funds. That's everything you need, from growth to dividends, international stocks, bonds, and even real estate. Now I want to show you a special strategy you can use to get a little higher returns, but still the safety of that diversified portfolio. The strategy is called Core Satellite. It's the strategy used by most wealth managers and the strategy I use to invest my money. In the Core Satellite strategy, use the majority of your money, maybe around 75%, to invest in these index funds we talked about. That gives you exposure to thousands of stocks and bonds for stable returns. With the rest of your money, you invest in a handful of individual stocks. The fact that you're investing a much smaller amount means that you can only invest in the best stock picks that you find, and no individual company is going to be a big part of your portfolio. That means you get the opportunity for extra return on picking a few winning stocks, but none are going to tear down your portfolio if they crash. Now, there's nothing to say that you need this Core Satellite strategy. You can go with these 5 Vanguard Index funds for that index fund investing strategy and still beat your goals. Both strategies are going to give you the stable returns and cash flows without the huge risks in a market crash or the stress of constantly trying to pick stocks. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel and ask it in the comments. We'll make sure you get an answer in the next video.